The idea of intraday trading is intoxicating. It's the financial world's version of being a fighter pilot, fast, precise, adrenaline fueled, with the potential for spectacular rewards and equally spectacular risks. You're not buying a company for the next decade. You're dancing with the market's mood swings, trying to capture a slice of volatility between the opening bell and the closing auction. It's chess, but the board is made of liquid crystal and the pieces move at the speed of light. I'm not here to sell you a dream. I'm here to give you a map, a no BS, deeply researched guide to navigating the most intense corner of the markets. This isn't about getting rich quick. It's about the craft, the process, the psychological marathon of making and hopefully not losing money in the same day, every day. Here's a hook to chew on. Did you know that approximately 70 to 90% of retail day traders quit within their first 2 years? The statistic varies, but the message is brutal and consistent. Most people lose. They treat it like a casino, guided by emotion, devoid of strategy, and shredded by commissions and poor risk management. But the 10 to 30% who persist, they aren't geniuses. They aren't psychic. They've simply built a system, a repeatable, boring, disciplined system that they execute with robotic precision. That's what this is about, transitioning from the former group to the latter. So let's talk about what this really is. Intraday trading, or day trading, is the practice of buying and selling financial instruments within the same trading day. All positions are closed before the market closes. No overnight risk. No waking up to a tweet that gaps your stock 20% against you. What it is, a business of probabilities and risk management, a test of discipline, patience, and emotional control. A skill-based endeavor requiring continuous learning, a game of small, consistent gains compounding over time. What it is not, a lottery ticket or a guaranteed income stream, a hobby you do between Netflix episodes, a way to get back at the market after a loss, and crucially, it is not solely about the entry. The exit and position sizing are far more important. Your enemy isn't just the smart money or the algorithms, though they are formidable opponents. Your primary enemy is yourself, your greed, your fear, your ego, your impatience. A successful intraday strategy is, first and foremost, a system for managing you. You wouldn't perform surgery with a butter knife. Don't attempt to day trade without the right tools. Let's build your toolkit. First, the technology. You need a reliable brokerage. Think Interactive Brokers, Thinkorswim, TradeStation. You need direct market access, low commissions, and robust execution. Your platform is your cockpit. Know every button. For hardware, at minimum, 2 large monitors. Ideally, 3 or 4. You need space for charts, level 2 quotes, time and sales, and your trading journal. A fast computer and a reliable internet connection are not luxuries. They are necessities. Consider a backup internet source like a mobile hotspot. And real-time data is non-negotiable. Delayed data in day trading is like driving while looking in the rearview mirror. Then, the mental and financial foundation. You must use risk capital only. This is money you can afford to lose completely. Not your rent money, not your kid's college fund. Losing this should not affect your quality of life. This single rule is the bedrock of emotional stability. Next, your trading journal, your single most important tool for improvement. Every trade must be logged. Entry, exit rationale, time, price, position size, P and L, and critically, your emotional state. This is how you find your edge and your repetitive mistakes. Finally, a defined process, your pre-market routine, your market hours rules, your post-market review. This ritualization is what separates professionals from amateurs. Now, you have to understand the rhythm. The market has a pulse, it breathes. Ignoring its natural rhythm is like trying to swim against a riptide. The opening bell at 9:30 a.m. EST is where volatility is king. Overnight news and orders collide. This is where momentum and Gap strategies thrive, but it's chaotic and dangerous for the uninitiated. From about 10 a.m. to 11:30 a.m., the dust settles. Trends from the open often establish themselves. Then we hit the midday doldrums from 11:30 a.m. to 1:30 p.m. Volume and volatility often dip. Traders and algorithms take lunch. This is a tough time for many strategies. Choppiness reigns. The afternoon session from 1:30 p.m. to 3 p.m. often sees direction return. Trends may resume or reverse as Europe closes and positioning for the next day begins. Then comes the power hour from 3 p.m. to 4 p.m. Volume and volatility surge again. Institutional rebalancing and final adjustments create major moves. It's high reward and high risk. Finally, the closing auction at 4 p.m. But understanding it is crucial for context. Here's an interesting fact. The last and first hours of trading combined typically account for over 40% of the day's total volume. This is why so many strategies focus on these windows. Okay, so let's get into the strategies themselves. These are not secret formulas, but time-tested frameworks. Your job is to learn, simulate, and adapt one until it becomes second nature. First, price action and support/resistance trading. This is reading the story the price tells you, without the clutter of most indicators. The concept is that price moves in waves, creating recognizable highs resistance and lows support. The market tends to have a memory at these levels. Your edge comes from anticipating reactions at these zones. You need clean candlestick charts, maybe a volume profile, and most importantly, your ability to draw clear horizontal and diagonal trendline levels. Here's the play. Identify clear support resistance on a higher time frame, like the 1-hour chart. Then zoom into your intraday chart, say the 5-minute. Wait for price to approach that key level. Now look for confirmation. Don't just buy at support. Buy when price holds support and shows a reversal signal, a bullish engulfing candle, a hammer, a pin bar. Then place your stop loss just below the support zone for a long trade. Your profit target is the next significant level in the direction of your trade. This strategy teaches patience. You are a sniper, not a machine gunner. You might only get 1 to 3 high-quality setups per day. Next, momentum and breakout trading. You're not predicting the initial move. You're catching the ride once the move has shown its hand, the concept. When price breaks through a key level of consolidation with conviction, it often continues in that direction as new buyers or sellers pile in. Volume is your best friend here. A breakout on low volume is a fake out. You need to see volume spike to confirm the move is real. So, identify a compression period. A tight range, a triangle, a flag. Wait for the candle to close decisively beyond the boundary. Don't trade the initial spike. Wait for the close to confirm it's not a trap. Enter on a pullback to the breakout level, which now acts as support, or on the next momentum candle. Your stop goes on the other side of the pattern. This is about courage and avoiding FOMO, fear of missing out. Chasing a move that's already gone 2% is a recipe for disaster. Wait for the pullback or let it go. Then there's scalping, the art of the small, capturing tiny profits dozens of times a day. It's physically and mentally demanding. The concept is exploiting tiny inefficiencies in the bid-ask spread and very short-term momentum, holding trades for seconds to minutes. You need level 2 market depth and time and sales, the tape, to see the order flow. A broker with ultra-low commissions is critical. Focus on highly liquid instruments like major index futures or mega cap stocks. An example play using order flow. You watch the level 2 and see a large wall of buy orders at a certain price. You observe the time and sales and see selling pressure is being absorbed without price dropping. You anticipate that when those buy orders are executed, price will pop up. You buy ahead of that, aiming to sell into the pop for a 5 to 10 cent per share gain. Your stop is immediate. If price breaks through the buy wall instead of bouncing, you're out. This is pure discipline. You must take the small profit. You must take the small loss immediately. Greed is the scalper's cancer. One bad trade can wipe out 20 good ones. Another approach is mean reversion. or fading the move, betting that an extreme move will snap back to an average. The concept in a range-bound market, price tends to oscillate between extremes. When it reaches an overbought or oversold extreme, you bet it will return to the mean. You can use tools like Bollinger Bands or the RSI indicator along with identifying clear horizontal ranges. The play, identify a stock trading in a clear horizontal range. When price rallies to the top band and the RSI is above 70, overbought, look for a reversal candlestick pattern. Then you short, it's placing a stop just above the range high, targeting the middle or lower part of the range. But here's the critical warning. This strategy fails catastrophically in a strong trending market. Never fade a powerful news-driven breakout. Finally, there's news and catalyst trading. Trading the volatility around scheduled events like economic data or earnings releases. The initial knee-jerk reaction often reverses or extends in a predictable pattern. A common play is the fade the gap post-earnings. A stock gaps up 10% at the open on great earnings. In the first 5 to 15 minutes, it fails to make a new high and starts to fall. The thesis is the initial euphoria was overdone. Profit stop above the morning high, targeting a fill of the gap. This requires steel nerves and lightning-fast execution. The moves are violent. You must have predefined entry, stop, and target levels before the event happens. But listen, your chosen strategy is only 20% of the battle, and the other 80% is the holy trinity: risk management, psychology, and execution. This is your survival kit. For risk management, start with the 1% rule. Never, ever risk more than 1% of your total trading capital on a single trade. If you have a $30,000 account, your maximum loss per trade is $300. This ensures a string of losses can't destroy you. Next, stop losses. They are not suggestions. They are mandatory mechanical exits. Place them at a logical level where your trade thesis is proven wrong and never move them further away. You can move them to break even to lock in profits, but never widen them. Then, position sizing. This is the magic formula. Position size equals open parenthesis, account risk close parenthesis, divided by open parenthesis, entry price minus stop loss price, close parenthesis. If you have a $300 risk and you buy a stock at $100 with a stop at $98, you can buy 150 shares. This aligns your risk precisely. Also, set a daily loss limit, a hard limit like 3% of your account. If you hit it, you shut down the platform. Walk away. This prevents the revenge trading death spiral. Trading psychology is about taming the beast within. You must cultivate emotional detachment. You are not your trades. A losing trade is not a failure. It's a cost of doing business. A winning trade doesn't make you a genius. Focus on process over outcome. A well-executed trade that loses money is a good trade. A poorly executed trade that makes money is a bad trade, and it's dangerously seductive. Understand that boredom is your ally. The market is manic depressive. You must be meditative. Most of the day is waiting. Learn to be comfortable with inactivity, and things like mindfulness, exercise, and a healthy lifestyle aren't hippie nonsense, and they regulate your nervous system, which is your most important trading tool. Finally, execution. Master your order types. Know the difference between market, limit, and stop orders. Use limit orders to enter where you want, not at any price. Be aware of slippage. In fast markets, your fill price may be worse than expected. Factor this into your risk calculations, and absolutely no hopium. Do not sit in a losing trade hoping it will come back. Your stop is your savior. Respect it. So, what does this all look like stitched together? A day in the life of a disciplined trader might start at 6:30 a.m. Wake up, no screens, meditate, light exercise, healthy breakfast. By 7:30 a.m., you're in pre-market review. Scan the news, check the economic calendar, review watch lists, identify key levels, form a bias, not a certainty. At 9:15 a.m., final preparation, clear desk, open journal, set daily loss limit, breathe. From 9:30 a.m. to noon, that's trading session 1. Execute only if your setups appear. No forcing trades. Log every entry instantly. If you hit your daily loss limit, you stop. No no exceptions. From noon to 1 p.m., step away. Eat, go outside. Do not stare at charts. From 1 p.m. to 4 p.m., trading session 2, reassess the market structure. Has the morning trend changed? Adjust bias if necessary. Continue to follow your rules. At 4:15 p.m., you begin your post-market review. This is the most important hour. Journal every trade in detail. Analyze. Did I follow my plan? What was my emotional state? What can I learn? Plan for tomorrow. By 5 p.m., you shut down. Mentally clock out. Your trading day is over. Engage in life. The path forward is a marathon. Start by paper trading for at least 3 to 6 months. Prove to yourself you can be consistently profitable in simulation with real-time data. This builds muscle memory without financial risk. When you go live, start microscopically. Trade one share or a single micro futures contract. You are trading to perfect your execution and psychology, not to make money. Only increase your position size when you have at least 3 consecutive months of consistent small profitability, and commit to continuous education. The market evolves. Read the essential books like Trading in the Zone by Mark Douglas. Join serious trading communities, not echo chambers of gamblers. Review your journal weekly and monthly. Intraday trading success is not a destination. It's a never-ending journey of self-improvement. It will challenge your character, your intellect, and your emotional fortitude. But for those who respect the market, who dedicate themselves to the craft of risk management and disciplined execution, it offers a unique and profound form of freedom. Not just financial, but the freedom of self-mastery. The bell is about to ring. Your cockpit is waiting. It's time to build your system. Trust your process and take control of your journey, one tick at a time.